Something in the United States didn't collapse loudly. It didn't arrive with sirens, headlines, or a single defining moment. It failed quietly, almost invisibly, through absence, through what never came. Millions of people followed the instructions exactly as they were given. They showed up every morning. They stayed late. They committed decades of their lives to companies, institutions, and systems that promised stability in return. Now, many of them are approaching the end of their working years and finding nothing there. No pension to rely on. No meaningful savings. No clear transition out of labor. What disappeared wasn't postponed or temporarily inaccessible. It was simply taken out of the equation. What makes this moment uniquely volatile isn't material hardship by itself. It's the dawning awareness that the system was never built to allow people to stop working with dignity. It was designed to extract effort continuously, right up until physical or mental capacity gives out. Exhaustion was never a malfunction. It was part of the design. For most of the 20th century, the American economic story rested on a widely accepted structural premise. If you worked long enough and consistently contributed, you would eventually reach a stage where labor was no longer required just to stay alive. This wasn't framed as hope or aspiration. It was an embedded assumption. Retirement was not something you earned by beating the market or making perfect choices. It was an endpoint engineered into the system itself. The economy assumed there would be a door at the end of the hallway. That belief shaped how people behaved across generations. Workers were willing to accept modest wages in exchange for long-term security. Employers valued retention because loyalty reduced costs and preserved institutional knowledge. Government policy reinforced this arrangement through labor protections, favorable tax treatment, and the creation of Social Security in 1935 as a baseline safeguard against destitution in old age. By the middle of the 20th century, especially during the 1960s and 1970s, more than 60% of private sector workers were covered by defined benefit pension plans. Retirement was not about accumulating wealth or living lavishly. It was about certainty, knowing that after enough years of contribution, income would continue even when work stopped. That certainty mattered because it connected effort to outcome in a straightforward way. You didn't need advanced financial skills, insider knowledge, or perfect timing. You didn't have to predict market cycles. You needed time and consistency. The system itself absorbed volatility. When markets dropped, pension checks still arrived. When inflation rose, benefits adjusted slowly but dependably. Risk existed, but it was carried by large institutions capable of surviving instability. Individual workers were not expected to act as shock absorbers for the entire economy. This structure also shaped how people understood adulthood and planned their lives. Mortgages were written with the assumption of predictable retirement income. Healthcare decisions were made expecting employer coverage up to a specific age. Even personal savings followed a different logic. Emergency funds were smaller because long-term income security was assumed to be stable. The system wasn't especially generous, but it was readable. People could understand it. They could plan around it. What makes today's situation so disorienting isn't just that outcomes have deteriorated, it's that the foundational promise dissolved quietly without a replacement. The language never changed. Hard work, responsibility, discipline. But the structure supporting those words was dismantled. Since 1950, productivity has increased by more than 250%. Corporate profits as a share of GDP have climbed above 12% in recent years, near historic highs. Yet the endpoint that once justified decades of endurance has become vague, conditional, and deeply uncertain. Today, Americans between the ages of 55 and 64 hold a median retirement savings of roughly $120,000. That number isn't just insufficient, it's a signal. It reflects a system that still demands everything from people, but no longer guarantees anything in return. At today's prices, that amount barely stretches far enough to cover about 2 years of basic survival costs. It does not resemble anything close to long-term retirement security. Social Security payments average roughly $1,900 a month, or about $23,000 annually, a figure that hovers just above the poverty line for older adults in many parts of the country. These outcomes are not the result of laziness, poor planning, or individual failure. They are the predictable result of a system that no longer offers a clear ending. That distinction matters more than it seems. The promise of an endpoint is what once held the entire structure together. When people believe there is a finish line, they are willing to endure pressure, instability, and sacrifice along the way. When that belief fades, stress doesn't simply accumulate, it mutates. It turns into resentment, chronic anxiety, and eventually disengagement. An economy can survive without hope, but it cannot survive without legitimacy. Once people stop believing the system is fair, participation becomes fragile. When the promise lost its reliability, accountability didn't vanish. It shifted downward. What followed was not an abrupt breakdown, but a quiet redesign of responsibility itself. Starting in the late 1970s and accelerating throughout the 1980s and 1990s, retirement security was steadily transferred from institutions to individuals. Guaranteed pensions that paid income for life were phased out and replaced with defined contribution plans, where outcomes depended entirely on investment performance, continuous employment, and flawless personal behavior. The scale of this transition is visible in the data. In 1980, about 60% of private sector workers had access to traditional pensions. Today, fewer than 15% do. At the same time, more than 70% of workers with retirement plans are now enrolled in accounts directly exposed to financial markets. On paper, this transformation was sold as freedom and empowerment. In practice, it stripped certainty out of the system. Under the previous model, risk was pooled. Employers and pension funds managed volatility across long time horizons, absorbing recessions and smoothing downturns. Individual workers were insulated from short-term shocks. Under the new model, volatility is personal. Market crashes no longer threaten institutions first. They hit households directly. A 20% market drop is no longer an abstract headline. It translates into postponed retirement, permanently lower income, or being forced to sell assets at the worst possible time. This shift happened alongside another fundamental change. Wages stopped rising in step with productivity. Since 1979, productivity has increased by more than 60%, while hourly compensation has grown at barely half that pace. As earnings stagnated, workers were told to save more with less. Contribution requirements increased. Employer matches weakened or vanished. Fees quietly drained balances year after year. The system began to demand ideal conditions to function properly. Uninterrupted careers, stable markets, and decades without personal or economic crisis. Those conditions are rare in real life. Most people experience layoffs, illness, caregiving responsibilities, recessions, or all of the above. The design left no margin for error. Crucially, this transformation was never framed as a sacrifice. There was no public reckoning with the fact that retirement security was being made conditional rather than guaranteed. The language focused on choice, flexibility, and ownership, while carefully avoiding any discussion of what happens when markets fall or plans fail. A system that once promised income replaced that promise with opportunity, without acknowledging that opportunity includes the possibility of loss. By the early 2000s, this weakness had become embedded. Market crashes, including those in 2008 and 2020, wiped out trillions in retirement savings. Yet the structure itself remained untouched. Instead of restoring guarantees, the response was to emphasize personal responsibility even more. As instability shifted from exception to norm, the outcome wasn't confusion. It was exposure. Workers now carry risks once absorbed by corporations, insurers, and governments, but without the scale, resources, or time horizon required to manage those risks effectively. The system didn't fail to warn them. It simply assumed they would adapt. Retirement was not eliminated outright. it was quietly redefined into a matter of odds. Once financial risk was transferred from institutions to individuals, the system implicitly relied on another factor to offset that exposure. Higher earnings were supposed to fill the gap. That expectation never materialized. Instead, what emerged was a steadily widening divide between what people bring home and what it costs simply to remain economically stable. This divide isn't abstract or speculative. It shows up clearly in data, persists over time, and is built into the structure of the modern economy. Since the early 2000s, wages have increased in nominal terms, but the prices of essential goods and services have risen faster and with far less room for adjustment. Income growth exists on paper. Purchasing power does not. Housing makes the imbalance impossible to ignore. Around the year 2000, the median home price in the United States hovered near $170,000. Today, it exceeds $420,000. Rental markets followed the same upward path. In many metropolitan areas, the national median rent now surpasses $2,000 per month. For households earning close to the median annual income of roughly $59,000, housing alone consumes between 30 and 40% of gross earnings. That threshold is critical. Once housing costs cross it, saving stops being a realistic option, even if it still exists as an expectation. Healthcare intensifies the pressure further. Employer-sponsored insurance premiums have increased by more than 300% since 2000, dramatically outpacing wage growth. The average annual premium for a family now exceeds $24,000, with workers directly paying more than $6,500 of that amount before deductibles even begin. Those deductibles average over $1,700 per person. These costs are not optional or avoidable. They are prerequisites for staying healthy enough to work and financially solvent enough to participate in the labor market. When income fails to keep pace, these expenses do not adjust downward. They squeeze everything else out. Insurance, education, utilities, and transportation follow the same pattern. Auto insurance premiums have risen more than 20% nationwide. Electricity prices in many regions have climbed over 30% since 2020 alone. College tuition has tripled since the 1990s, while student loan structures ensure repayment stretches across decades of working life. Each of these costs can appear manageable when viewed in isolation. Together, they function as a permanent lien on income. This is where the underlying design of the modern economy becomes visible. Saving is framed as a moral responsibility and a personal discipline, yet the system claims income long before saving can occur. The sequence is reversed. First, pay for housing. Then healthcare. Then insurance, utilities, transportation, and debt service. Only afterward does saving become theoretically possible. For tens of millions of households, that final step never arrives. There is nothing left to allocate. The lack of savings is not a failure of character or planning. It is the predictable result of a cost structure that expands faster than wages. The data reflects this compression clearly. Around 60% of Americans report living paycheck to paycheck. Nearly 40% say they could not cover a $400 emergency without borrowing money. These patterns appear across income levels, not just among low earners, because the pressure is embedded in baseline costs that rise regardless of effort or productivity. This erosion does not require dramatic inflation spikes. A steady 3% annual increase in essential expenses over 20 years is enough to eliminate financial margin entirely. That matters because the retirement framework built in recent decades assumes surplus. Contributions to long-term investment accounts require excess cash flow. Participation in financial markets assumes patience, consistency, and uninterrupted deposits. The modern cost environment undermines all three. When households are forced to prioritize immediate survival expenses, long-term planning becomes fragile. Retirement, under these conditions, is no longer a destination. It is a conditional outcome dependent on uninterrupted stability in a system that increasingly offers none. People don't draw down long-term savings because they suddenly lose faith or act irrationally. They do it because real life shows up. A medical emergency, a layoff, a move to another city, caring for a parent, supporting a child. These moments turn accounts that were meant for the future into tools for immediate survival. Over time, the money may still exist on paper, but its purpose shifts. It stops representing tomorrow and starts functioning as a shock absorber for today. What makes this especially destabilizing is how uneven the pressure is. Expenses are fixed and inflexible. Income is not. During economic slowdowns, wages freeze or decline, yet costs continue climbing. When the economy rebounds, prices rarely retreat. This one-way ratchet means each cycle leaves households more constrained than before. Growth returns activity, not durability. People may be working again, but they are more exposed than they were previously. At the national level, this setup keeps consumption alive while quietly hollowing out security. Spending stays elevated not because households are thriving, but because they lack alternatives. Credit becomes the substitute for missing income growth. Total household debt now exceeds $17 trillion, with credit card balances alone topping $1.1 trillion, often carrying interest rates above 20%. Borrowing sustains demand in the short term, but it pulls future earnings into the present, shrinking the space for saving even further. This is not a passing distortion. It is a built-in feature. When wages trail behind unavoidable expenses, time stops working in favor of the worker. Each additional year on the job does not build protection. It simply postpones vulnerability. The longer this imbalance continues, the harder it becomes to correct, because the financial margin required to recover no longer exists. The consequences extend well beyond finances. A system that absorbs nearly all available income leaves no room for mistakes. Stability becomes dependent on perfect continuity, uninterrupted employment, good health, and ongoing access to credit. That fragility increases with age, not because of bad choices, but because time reduces the number of available paths forward. As costs and earnings press closer together, time itself becomes the limiting factor. What begins as a budgeting problem slowly turns into a structural trap, most visible in midlife. The system assumes flexibility well into people's 50s and 60s, yet its design steadily removes the very options needed to adjust when things go wrong. This is where long-term risk becomes unavoidable. Labor markets begin treating age as a disadvantage long before a person's ability to work actually declines. Participation drops sharply after age 55, not due to reduced willingness, but reduced opportunity. After a job loss, workers over 50 take nearly twice as long to find new employment compared to those in their 30s. When positions do appear, they often come with lower pay, fewer benefits, and greater instability. Income doesn't just pause. It resets at a lower level. For a system that depends on steady contributions and continuous earnings, that reset is devastating. At the same time, health shifts from a background concern into a dominant force. Medical costs rise sharply with age, even for those who are insured. Average annual healthcare spending for individuals over 55 exceeds $11,000, almost double the amount spent by younger adults. A single procedure, diagnosis, or extended recovery can wipe out years of careful planning. Unlike market risk, health risk cannot be spread out, diversified, or postponed. It arrives when it arrives. The collision between weakening job prospects and rising medical exposure exposes a deeper assumption embedded in the modern retirement model, that people can simply work longer if their plans fall short. In reality, that assumption collapses under real-world conditions. As people age, the kinds of work available to them begin to narrow. Jobs that rely on physical endurance become increasingly difficult to maintain year after year. At the same time, roles built around knowledge and expertise grow more competitive and more sensitive to age. Employers prioritize flexibility, speed, and cost control, areas where older workers are often penalized regardless of experience or institutional memory. The issue is not capability. It is perception shaped by efficiency metrics. Debt tightens these constraints even further. Mortgages now routinely stretch into the late 60s, driven by soaring home prices and longer repayment terms. Student loans, once associated with early adulthood, now follow borrowers deep into middle age, with more than $200 billion in outstanding balances held by Americans over 50. Credit card debt, often accumulated to cover shortfalls during income disruptions, carries interest rates that accelerate depletion precisely when earnings weaken. What began as a temporary bridge slowly turns into a permanent drain on cash flow. At this stage of life, the system provides almost no meaningful paths for correction. Changing careers requires time, retraining, and upfront investment, resources that midlife workers rarely have in surplus. Moving to a lower-cost area is often blocked by housing market realities and family responsibilities. Downsizing, frequently promoted as a solution, often fails to release usable capital once transaction costs, rising rents, insurance, and taxes are accounted for. Financial breathing room disappears, just as adaptability should matter most. This outcome is not random. It reflects a model built around efficiency rather than continuity. Workers are treated as interchangeable components instead of long-term contributors. When costs rise or productivity slows, older employees are quietly pushed aside. Yet the retirement framework assumes those same workers can simply stay employed longer if their savings fall short. The contradiction is never addressed. It is postponed. The psychological consequences mirror the financial ones. Planning horizons shrink. Decisions shift from building toward protecting. Long-term goals give way to short-term survival. The objective becomes staying afloat rather than moving forward. This is not a collapse of motivation or drive. It is a rational adaptation to narrowing choices. By midlife, the central question is no longer whether retirement is achievable, but whether disruption can be avoided at all. Stability becomes conditional. It depends on uninterrupted health, continuous employment, and a tolerance for sustained pressure. As reliance on safety nets grows, those nets become thinner. The range of available options contracts precisely when dependence increases. This narrowing of choice reveals a deeper pattern. When adjustment is no longer realistic and adaptation is limited, responsibility shifts once again, not upward toward institutions, but inward toward individuals. The burden does not fall because people are uninformed. It falls despite widespread awareness. Perhaps the most disturbing element of this crisis is not that institutions failed to anticipate it, but that they documented it decades in advance. The warnings are embedded in actuarial models, budget forecasts, and long-term fiscal analyses stretching back generations. The disconnect between what is known and what is publicly emphasized is not accidental. It is systemic. Public agencies have long acknowledged the imbalance. Trustees of Social Security have repeatedly warned that the program faces funding shortfalls within the next decade. Medicare's projected obligations extend tens of trillions of dollars beyond its dedicated revenue streams. When measured over long horizons, unfunded federal commitments for retirement and health care exceed $70 trillion. These figures are not concealed. They are published, quietly debated, and then deferred. The silence continues because confronting the implications carries political risk. The problem is visible. The math is clear. What remains unresolved is the willingness to say out loud what the system has already calculated. Any straightforward explanation has to accept several uncomfortable realities at the same time. First, most people will be expected to stay in the workforce longer than previous generations. Second, the benefits they eventually receive will buy less in real terms. Third, even higher contributions will still fall short of closing the gap. Each of these truths is politically hazardous on its own. Taken together, they form a message no elected leadership is eager to deliver openly. The result is not reform, but postponement dressed up as reassurance. Rather than addressing the underlying imbalance, institutions lean on small, incremental changes that preserve the appearance of stability. Eligibility ages quietly rise. Cost of living adjustments trail actual inflation. Proposals for means testing appear, spark resistance, and then disappear. None of these measures confront the central problem. A framework built for a younger population with rapid labor force growth cannot sustain an aging society where wages barely move. The numbers simply do not align. Still, the public narrative remains upbeat. Regulatory agencies and economic authorities reinforce this tone through careful framing. Official reports focus on how long programs can continue paying benefits rather than whether those benefits are sufficient to support a decent standard of living. Solvency is emphasized, adequacy is not. A system can technically remain solvent while steadily failing the people who rely on it, but that distinction is rarely highlighted. As long as payments continue, the system is labeled functional, regardless of what those payments actually provide. This ambiguity serves powerful interests. Asset-based retirement structures generate fees no matter how individuals fare. Defined contribution plans now hold more than $8 trillion in assets, creating stable revenue streams for fund managers, even as account balances rise and fall unpredictably. Market swings push risk onto individuals, while profitability at the institutional level remains largely protected. The machinery runs smoothly at the top, while becoming increasingly unstable at the bottom. The arrangement survives on a combination of trust and inertia. People keep contributing because there are few alternatives, and early withdrawal often brings penalties. Employers maintain plans because doing so satisfies legal and reputational expectations, without obligating them to guarantee outcomes. Governments avoid confrontation because even fragile continuity feels safer than publicly admitting structural failure. Complexity strengthens this silence. Retirement financing stretches across decades, blends public programs with private markets, and resists simple explanation. That complexity becomes a shield. When results disappoint, responsibility splinters. No single actor appears directly accountable, even though the system's design produces entirely predictable outcomes. Over time, the emotional cost of this silence compounds. As responsibility is pushed inward, individuals begin to interpret systemic shortcomings as personal inadequacy. Self-blame replaces collective scrutiny. And a population that feels isolated and at fault is far less likely to demand structural change. In this way, silence reinforces itself. What ultimately emerges is not a coordinated plot, but alignment. Political incentives, financial interests, and institutional caution converge around delay. The system continues operating not because it delivers security, but because acknowledging its limits would force decisions that no institution is prepared to confront in public. This pattern of avoidance pushes the final burden away from concrete policy choices and onto perception itself. When institutions stop speaking clearly, stories rush in to fill the silence. And when that silence collides with a culture of personal responsibility, the outcome isn't an immediate breakdown. It's a widening disconnect between what the system quietly expects people to endure and what real lives can actually sustain. That disconnect doesn't show up neatly in headline statistics like unemployment rates or stock market performance. It reveals itself in subtler ways: constant alertness, shrinking room to maneuver, and the persistent absence of relief. From an economic standpoint, it appears as ongoing instability rather than sudden collapse. Nearly 6 in 10 Americans report living paycheck to paycheck, even while GDP grows and corporate profits remain high. Household debt has climbed past $17 trillion. Meanwhile, inflation-adjusted median wages have barely advanced over decades. These figures coexist because the system no longer depends on security to keep running. It only depends on continued participation. The psychological toll is even heavier. When long-term planning loses reliability, attention collapses into the present. Financial choices stop being about progress or opportunity and become exercises in damage control. People aim not to get ahead, but to avoid falling behind. Willingness to take risks evaporates. Optimism narrows. The future no longer feels like something to build toward. It feels like a problem waiting to happen. This isn't irrational fear. It's a rational adjustment to sustained uncertainty. Social consequences follow quietly. Anxiety becomes commonplace and unremarkable. Comparison intensifies shame. Individuals assume they are failing on their own, even as millions share the same pressures. Without collective acknowledgement, trust fractures. If the system is portrayed as healthy, then hardship must be personal. That logic isolates people at the very moment shared strain should produce collective demands for change. What makes this moment genuinely dangerous is not hardship by itself, but endurance without resolution. Societies can survive periods of crisis when people believe recovery lies ahead. They cannot endure endless pressure without a believable exit. As the gap persists, disengagement spreads. Confidence in work erodes. Confidence in planning weakens. Confidence in fairness dissolves. This is why the cost of living crisis cannot be understood as merely an economic problem. It is existential. An economy that consumes effort without offering closure eventually drains consent. When people no longer believe time will improve their situation, they stop investing emotionally, socially, and economically. Nothing dramatic has collapsed yet, but something essential has already slipped away. Systems like this rarely fail in a single moment. They empty out slowly. They lose meaning before they lose function. And once that hollowing becomes permanent, recovery is no longer just a question of better policy. It becomes a question of whether the system itself can still sustain human participation at all.